Welcome to our deep dive on FSA prepayment hacks, leveraging discounts with tax-free dollars while staying within IRS rules. In this video, we will clearly explain the date of service rule, show how prepayments can still work under many plans, and highlight risks so you can make informed decisions. We will begin with an agenda, and then move into a simple framework and diagrams to visualize timing and reimbursement flows. Here is our roadmap. First, we will define the strategy. Next, we will unpack the date of service rule. Then, we will explain when prepayment can still work within plan rules. After that, we will cover the critical prepayment risks. We will then outline a step-by-step execution checklist and discuss common administrator objections. We will also walk through scenarios, diagrams, and a timeline. Finally, we will test your understanding with a quick quiz and close with key takeaways and a summary. This content is educational and is not tax, legal, or financial advice. Before taking action, consult your specific FSA plan documents, your administrator, and a qualified professional. Policies vary by employer and administrator, and regulations change over time. The central idea is to prepay for future healthcare services to lock in a discount and then combine that with tax-free FSA reimbursement when the services actually occur. This can stack savings, the provider discount plus the tax advantage. However, the key is to follow the date of service rule properly and to manage real risks of prepaying. Under most FSA plans, eligibility for reimbursement depends on the date the service is provided, known as the date of service, rather than the payment date. If you prepay in 2025 for services delivered in 2026, the expense is considered incurred in 2026. You should submit claims after each visit in 2026, providing documentation that clearly shows the date of service. This timing distinction allows you to capture discounts up front while still complying with the rule by waiting to seek reimbursement until the service is actually delivered. This flowchart shows the end-to-end journey from deciding to prepay to ultimately receiving reimbursement. First, you decide to prepay and secure a written quote or invoice that lists services by their future dates. Then, you make the prepayment. Next, you wait until each appointment actually occurs. Once a service is provided, you obtain an itemized invoice showing the date of service and amount. If insurance is involved, you wait for the explanation of benefits before submitting the FSA claim. Then you submit the claim with the DOS documentation. The FSA administrator reviews your claim and either reimburses or requests more information. If additional documents are requested, you supply any missing DOS or amount details, and then reimbursement is issued. The diagram also highlights a risk branch. If the provider's business fails before services are delivered, you may face a potential loss and a difficult recovery, which is a core prepayment risk. On the left, the strategy can be advantageous because you combine provider discounts with FSA tax savings, pay up front and claim later by date of service, and potentially smooth cash flow when planned well and approved by your administrator. On the right, the trap involves locking your capital with the provider, exposing you to business failure or ownership changes, facing denials if your documentation lacks the proper date of service or mismatches the service year, and having limited recovery options for prepaid funds if services are not delivered. To execute safely, first confirm your plan rules by reviewing the summary plan description and any administrator guidance for date of service language and prepayment policies. Next, obtain an itemized quote in writing that links the prepayment to specific future services and dates. Use traceable payment methods and retain receipts. After each appointment, secure an invoice showing the exact date of service and amount. If insurance applies, wait for the explanation of benefits so your FSA claim reflects your true patient responsibility. Submit claims per visit, not all at once, and include all supporting documents. Limit your prepayment to an amount you can afford to risk, and consider diversifying providers to reduce exposure. Monitor the provider's business stability and maintain a thorough paper trail of all quotes, receipts, DOS invoices, EOBs, and administrator communications. Administrators may object if your paperwork lacks a clear date of service, or if the service year does not match your claim. They may also deny if your prepaid package resembles a gift card or retainer without itemized services. Claims filed before services occur are commonly rejected. Discrepancies between your claim, the EOB, and the provider invoice can also trigger denials. Finally, some policies explicitly forbid reimbursement for services not yet rendered, so understanding and adhering to that policy is essential. This table compares common scenarios. In the first scenario, you prepay in 2025 for care delivered in 2026. Eligibility occurs after each 2026 visit, with a medium risk profile and the need for sufficient 2026 FSA funds. The second scenario is pay-as-you-go in 2026, which is eligible after each visit and tends to be low risk. The third scenario involves a large prepaid bundle with an unstable provider. While eligibility would still be after each 2026 visit, the business risk makes it high risk. The final scenario describes prepaying in 2025 but attempting to claim in 2025. This typically is not eligible due to the date of service mismatch and is likely to be denied. This timeline highlights that the prepayment occurs in 2025, but services are provided across 2026. It shows claims submitted after each 2026 service date and reimbursements following administrator review. The key callouts emphasize that eligibility is anchored to the 2026 dates of service, and that you should ensure sufficient 2026 FSA funds are available to support those claims as the services occur. Quiz time. The question is, under most FSA plans, when is an expense considered incurred for reimbursement eligibility? The options are A. When the payment is made, B. When the service is scheduled, C. When the service is received, also known as the date of service, and D. When the provider issues a quote. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is that an expense is incurred when the service is received, or the date of service. This anchors eligibility, and is the reason prepayment in a prior year does not by itself trigger reimbursement. Your documentation should include an itemized quote that links the prepayment to future services and dates, proof of payment with full receipt details, per-visit invoices that explicitly state the date of service and the patient responsibility, any explanation of benefits documents when insurance applies, and written confirmation from your administrator that prepaid scheduling with DOS-based claims is acceptable under your plan. Here is the critical warning. Prepayment locks your funds with the provider. If the provider fails, closes, or changes hands before you receive all services, recovering those funds is often difficult, particularly when those funds are intertwined with tax-advantaged accounts. Proceed carefully and avoid excessive exposure. Consider a simple example. You plan 10 visits at $100 each, totaling $1,000. The provider offers a 25% discount for prepayment, so you pay $750. If your combined tax rate is roughly 30%, the tax advantage on $1,000 of eligible 2026 services could be around $300. That implies a combined benefit of approximately $550 before considering risks and administrative friction. However, this benefit assumes that you have adequate 2026 FSA funds and proper date of service documentation for each visit. This mind map places the FSA prepayment decision at the center and explores considerations in 5 categories. Under Plan Rules, confirm the date of service policy and whether prepaid packages are allowed. Under Provider, evaluate stability, refund policies, and documentation quality. Under Financials, weigh the discount percentage, your tax bracket, cash flow needs, and the cap on your exposure. Under Process, ensure you can obtain per-visit invoices, understand EOB timing, and set a cadence for submissions. Under Risk Controls, diversify providers, get written confirmations, and limit how much you prepay. Here's another quick quiz. Which document most often helps align your FSA claim with the date of service when insurance is involved? The options are A. Bank statement, B. EOB, or explanation of benefits, C. Provider marketing brochure, and D. Scheduling confirmation email. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is the explanation of benefits. The EOB shows the final patient responsibility tied to a specific date of service, which helps the administrator validate your claim. The main takeaways are that eligibility is based on the date of service, not the payment date. Prepaying can combine provider discounts with tax savings provided that claims are submitted after each date of service. Documentation is crucial, including itemization, dates of service, EOBs, and receipts. You should cap your risk and assess provider stability before making large prepayments. Finally, confirm your plan rules and obtain administrator guidance in writing. In summary, You can use timing to your advantage while respecting the date of service rules. Document thoroughly and submit claims per visit. Control your risk by avoiding excessive prepayment and considering provider diversification. Verify policies with your administrator before paying. Weigh the potential stacking of discounts and tax savings against the very real risks associated with prepayment. Thank you for watching. If this was helpful, please like the video, share it with someone who values smart savings, and subscribe for more practical content. I would love to hear your perspective on FSA prepayments, so please share your experiences or questions in the comments.